The Federal Reserve met today and they paused rate hikes again for the second meeting in a row. So that means the current federal funds rate sits between 5.25 and 5.5%. And this was widely expected ahead of the meeting. Now, today we're going to talk about what exactly that means for you, your stocks, the housing market, etc. But first, let's actually recap what happened today. So let's actually go right here. And you can see that the federal funds rate increases since 2022 right here have been pretty steady, like it's been increasing every single month. But this was the first time that there were two pauses in a row. That's pretty great. Now, in terms of what actually happened during the meeting today, you can actually pause and read this if you want, but we're only going to focus on the top paragraph right here. And this was the press release ahead of the actual meeting. And it says, recent indicators suggest that economic activity expanded at a strong pace in the third quarter. Job gains have moderated since earlier in the year, but remain strong, and unemployment rate has remained low. Inflation remains elevated. That was the press release. You can actually see that they just copy pasted this from September 20th, 2023. And most of it kind of just stays the same, but the top paragraph is what we want to focus on there. Digesting the news, the market actually responded quite positively. As you can see, the meeting was right around here. The S&P 500 ended up 1% on the day, as well as the NASDAQ was up 1.64% on the day after the meeting concluded. So let's actually listen to what Jerome Powell had to say about economic stability and basically the prospects of economic growth in quarter three.
Recent indicators suggest that economic activity has been expanding at a strong pace and well above earlier expectations. In the third quarter, real GDP is estimated to have risen an outsized annual rate of 4.9%, boosted by a surge in consumer spending.
All right, so 4.9% is what GDP grew by in quarter three of 2023. Now, 4.9% is rather high, but how does that compare to the previous quarters, as well as does that actually mean we're in a recession? So let's actually go right back here. And I'm going to show you guys that back in quarter one and quarter two of 2022, that was the technical recession. That's when we actually had two negative quarters of GDP negative growth. And we can see since then, it's just been growing every single quarter. And this has been our best quarter since quarter three of 2022. So things are looking up in the economy, and you might be wondering, but aren't we supposed to have a recession soon? So we'll talk about that later in this video, but let's actually look at some of the CPI changes from the month before. So CPI, if you guys know, is just inflation, and is one of the things that the Federal Reserve will look at when it's considering whether or not they should raise interest rates again or not to kind of cool inflation. So in September 2023, the CPI was 3.7% for the 12 months ending in September. That was exactly flat from the month before. If you want to look right here, here's the inflation breakdown for September 2023 all in one chart. You can see all the things that rose in prices from the year before. But the main thing that we should actually pay attention to is gas. Gas was only 3%, and if you remember from the previous video that I did in this style about the Federal Reserve meeting, gas was at plus 10.6% during the inflation report in August of 2023. So that's actually come down considerably, but core PCE is still 3.7%, and that still remains a little bit higher than the inflation target of 2% that the Federal Reserve wants. So let's actually listen to Jerome Powell on the next snippet on job growth and labor demand.
Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers.
All right, so what does that mean? The U.S. added 336,000 jobs in September, which is quite above the August, July, and June numbers. However, that usually could be a concern, and I'll explain why that is in a second. However, the main reason why it's not a concern is that wage growth has actually slowed back down to pre-pandemic levels. So there was this period in which we thought by adding too many jobs, that was going to be a big risk for the economy, because if we added too many jobs and wages kept going up, then what would happen is what's called a wage price spiral. So I want to illustrate to you guys what exactly that is and why that's actually not happening now, according to the data. So, oops. This is my janky little depiction here of the wage price spiral. So this is exactly what happens when wages go up. So when wages go up too much, what's going to happen is your production costs for making any widget or anything out there is going to go up. So if you think about it from a company's perspective, if I'm now paying my workers a lot higher, I'm going to have to make up for that cost somehow. So my production costs are going to go up because I'm paying my workers more, and therefore the pricing of my goods are going to have to increase. So if we think about this from, let's say, a car maker's perspective, if I have to pay my workers more, my costs are going to go up. I'm going to have to raise the prices on those cars, and that's actually the inflation that we're going to be talking about there. And so when prices go up like that, the average person is going to have lower purchasing power because they're making the same amount of money, yet the prices of the things they want are going up. And so those people are going to demand higher wages. Then the cycle basically continues. This is the wage price spiral that the Federal Reserve does not want. And so that's actually possibly not happening here, especially because the average hourly wage earnings only grew 0.2% for the month, which was well below the economist's average forecast for 0.3% and 4.3% respectively. All right, so that was the wage price spiral. Let's actually look at the median sales price of homes sold in the United States now. So let's transition to the housing market. It was $418,500 for the median sales price of a home back in the last video, but now in Q3 it's actually gone up. So housing prices, the median sales of housing prices have actually gone up, and the mortgage rates currently sit at 8% for a 30-year fixed mortgage. This was markedly higher than the 7.5% from the previous video as well. If we look at the September 2023 existing home sales, they fell to the lowest level since October of 2010. So people aren't buying houses. What can I say? They're getting more expensive. Mortgage rates are really high. The same mortgage is going to cost you a lot more. So people just aren't buying homes. You can see that while they aren't buying homes, the median sales price of existing home sales have actually gone up in almost every single region. So the left bar is 2023 and the right bar is 2022, the lighter blue. And in every single one of these categories, the median sales price of existing home sales have gone up, even though that Jerome Powell and the Federal Reserve is saying that housing has kind of cooled off. What we're actually seeing in the data is that perhaps it's staying either flat or it's going up slightly. Now, the good news is that housing starts, this was from the last video, if you remember, housing starts fell to the lowest since 2020 back in August, but they've actually recovered. So this was the lowest part right there from the previous video, and boom, recovered. So that's a good sign to see, and we're just gonna have to wait and kind of see where the housing market goes in the next few months. I personally think it's a nice time to buy a house, especially if you have a lot of cash. And that's because with rates so high, people are going to be pricing their homes a lot lower. And I just think not many people are going to be buying homes. And I'm kind of a contrarian type of thinker. I'm like, okay, if no one's going to be buying homes, that's probably when I want to be looking at purchasing something. That's just me. That's my opinion. I'm just a YouTuber here on the internet. So don't make that inform your, don't have that inform your purchasing decision if you're thinking about buying a home. But that's just kind of what's been on my mind recently. In terms of what the traders are pricing in for the Federal Reserve, for the federal funds rate, this was as of earlier. So let's actually refresh and see if it's changed. All right, so traders are pricing in a 22.5% chance that we actually raise rates in the next Federal Reserve meeting of December 13th, 2023, and a 78% chance that we kind of just stay at the same exact rates. All right, so you can see that as we move through all the Fed meetings in the future, the target rate probabilities are going to change. So in January 2024, there's a 2.3% chance it actually gets raised up to 5.75%. And then in March, there's a potential of a cut right here to 5%. And then in May, I think when you get all the way down to May, I don't think you can predict anything because it really depends on how the economy is doing. And that's what the Federal Reserve has been doing largely for this whole time, is they're gauging economic data and then making a decision about what they should do next. So let's actually listen to what Jerome Powell has to say about that.
In light of the uncertainties and risks and how far we have come, the committee is proceeding carefully. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook and for economic activity and inflation, as well as the balance of risks.
So what he means is that this was the entire summary of the Federal Reserve meeting. If you just want the summary, it's basically like, hey, we're just holding steady. We're going to see what happens. We need more economic data to kind of figure it out. And since inflation has been somewhat cooling off, they view that as a good sign, and that's why he upgraded his language around the economy to strong, right? So right now we're kind of in a holding pattern, and we're going to talk about how to prepare for 2024 shortly right here. Before we do that, let's actually talk about the stock market and Treasury yields, because I think that's going to be pretty fascinating. So a Treasury bill is a short-term U.S. debt obligation that's backed by the U.S. government. And what often happens is that if you buy these treasuries, they are virtually a risk-free return. So if we actually look right here, the 3-month US Treasury is paying 5.46% right now, and the 10-year Treasury is paying 4.73%. Now, if we look at the S&P 500, the annualized S&P 500 return with dividends reinvested is 7.804%. That means if you are actually risking your money in the stock market, over the past 25 years, you would have gotten a 7.8% return. But that might not be worth risking your money for if you can get a 5.46% return in the market because of the Treasury yields right now. The Treasury yields are largely driven by the federal funds rate as well. And so what you have happening is that a lot of investors are moving their money into treasuries and not into stocks because they're getting a safer return there. However, if we look at the one-day chart for the 3-month Treasury, you can see that right after the Federal Reserve meeting, that it started to go down. And same with the 10-year Treasury. After the Federal Reserve meeting happened, it started to trade lower. So this could be a signal that many people might want to start moving some of their cash into stocks. All right, so let's talk about some practical tips to prepare for 2024. I actually have the cover photo of GameStop right here. Hopefully that is not an indication of how 2024 goes, but I just thought it was fun. There are 5 things I think you should do to prepare for 2024. 1 and 2 are very interconnected. Think long-term, invest. If you're going to be investing, think about a 10, 20, or 30-year time horizon. We don't want to just be day trading. Number 2, don't panic. Things are going to happen. It's going to be volatile in the stock market. And if you're going to sell all your stocks at the very first moment of volatility, you probably shouldn't be investing in the first place. Number 3, pay down any debt or high interest rate debt that you might have. Excuse the Discord notification there, but paying down debt is always a good idea, especially if it's high interest rate debt. That means you're going to hopefully be getting more for your money that way. Number 4, simple. Keep your emergency fund up. 6 months of living expenses, 3 months of living expenses. And then lastly, if you want, you can allocate more cash if you believe a recession is on the way. Nobody knows if a recession is on the way. Obviously, things are very fragile in the economy right now. A lot of people are getting squeezed, so this could be a possibility, but no one really knows, and no one knows when it's going to happen. However, if you think it's going to happen within the next 12 months, maybe you have a gut feeling, maybe you have some sort of inside information. If you do, please tell me. You might want to allocate some more cash into your holdings and maybe just wait and see what happens, what type of buying opportunities are out there. Number 6, subscribe to this channel. Had to throw that in there. Come on. All right. So in terms of number 1, thinking long term, I have a few nuggets for you that I want to leave you guys with. If you Google stock market overvalued in 2012, you can see that the first article right here, someone said that US stocks were overpriced by 50%. Now, that's pretty crazy because if we look at the S&P 500 and we zoom all the way out, 2012 is right here. The S&P was trading for 1,400. These days, it trades for 4,200. You would have lost out on 3x your gains if you thought the stock market was overvalued in 2012. So, what does that tell you? Keep a long-term mindset. Lastly, this is my favorite blog. It's by Of Dollars and Data. I'll link it down below. This is my favorite blog post, actually. It kind of shows you the returns of the stock market annualized over different time periods. So this is an interactive GIF or GIF, if you will. I don't know what you guys want to call it. But over a long period of time, you can see that positive real returns actually happen in the stock market. And he even says, what is interesting about this is that over any 20-year period, US stocks have had no real negative returns when including dividends. And over a 30-year period, the returns have generally converged despite some dispersion. This is a pretty fascinating graph to look at. You can see the red dots are when you lose money, but over time, it's generally positive. All right, so that was today's video. I hope you enjoyed another format of this. I don't know what to call this. I just call this Mogul Mail format because of Ludwig, my favorite streamer. So hopefully you enjoyed this video. Let me know what you guys thought in the comments, and I'll see you guys in the next video. Make sure to subscribe. Peace.